Hey everybody, this is Paul. This is going to end up being a dividend video. So, we're at the end of April here, so I guess let's kind of look at the market, see what's going on, see, I don't know, the back and forth, the craziness, the information, the news, just everything that's going on. So, we have the bond market that's beginning to price in a June-ish, July-ish debt ceiling crisis, anarchy kind of thing. So you can kind of look at the 1 month and see that it's literally swinging by 20 something basis points a day, and then you have the 2 month also. So what's going on with these situations right here is everything that you see in this area right here is related to like debt issues, um, you know, default, Congress, Joe Biden, those kind of things going back and forth with each other. So that's what's going on there on the short end. So what the market is trying to do is trying to figure out when do we default and what kind of protection can we buy before we get there. If we get there, that's just, I don't even know how to make a video about that. I know it's bad. Let's put it like that. Um, Also today we have First Republic. Finally, might actually be going down this weekend. Somebody made this little meme right here, and I think it's pretty accurate. It's just one of these. Just everybody's just kind of waiting for the FDIC to just come in and just pull the plug on these guys. There's a good chance that happens this weekend. I mean, they're just getting destroyed today. I'm not sure who in their right mind is in there holding a short position or holding a buy position on this going into the weekend, but they're done. Like that stock is just done. So I guess the other big news is we got the GDP numbers, and it didn't happen, and it didn't come out as bad as everybody thought. Because if you listen to me or if you listen to anybody else, we could have told you consumption, people were spending like it was going out of style. You just had a lot of people just tax returns. There you go. They spent it all. Private investment from companies, like people, like manufacturers, that kind of stuff, they cut back. This obviously appears in the JOLTS numbers. This appears in just pretty much all the manufacturing surveys that are just showing Armageddon. Well, this is what you get. You get negative investment here, and but then you have the consumer on the other side still willing to take on debt because the jobs picture is really good. So where are we at? Like what's going on here? I'm pretty sure. So if you look at Q2, for example, this includes like the summer months and whatnot. It might end up being very similar to Q2. I mean, unless you start seeing job losses. If you don't see job losses, like negative job reports, people are just aren't going to pull back spending. It's just not how it works. So I could tell you right now, like so, for example, I do DoorDash. You can kind of see the consistency here. Now you can see right here, for example, this is when the peak of the tax returns are here. You can literally see the date range right there. And my dollar per mile shot up, but then you can see it kind of faded off a little bit. So you can tell it's a little slower out there, but you can tell there's more people doing DoorDash as like, teachers go on breaks for like spring break and stuff like that. So as long as people still have jobs, they're going to spend money. It's just how it works. It's just how our economy works. It's like that's the entire point of consumerism. You can look up the definition. So until you start seeing larger job layoffs, because right now we're only seeing white collar job layoffs. Even the Gap layoffs the other day are all for their corporate office. Everything's corporate. Everything's white collar. And that goes under my assumption is that what happened during COVID is that redefined what the word essential meant. Because by now, in a normal recession, we just saw regular people getting laid off in very large numbers. So I think that's where we're kind of at. I have a feeling that Q2 GDP is actually going to look a lot like Q2 of 2022. Um, I don't see any reason why it wouldn't. Even although this is when they started raising rates, I could see fixed investment still being pretty, or like private investment still being low. The government part is definitely going to be questionable. If we default on the debt and it happens for a while, this government one is definitely going negative here pretty soon. But there's a lot of stimulus in the government stuff from different spending from bills that were passed under Democrats that still isn't even remotely in the system yet. So that's still going to come through on the government side. So we're still kind of waiting on these job cuts, and they may not actually happen. But here's the thing: is there's other indicators that are just showing nightmare scenarios. So these are the leading economic indicators, and as you can see, whenever we've had the leading economic indicators this low for this long, you always get a recession, and a pretty long one too, and a pretty brutal one. But I think what's going on is as things are blowing up, they're dealing with them very quickly so that they don't become a problem. Because in theory, this is the 13th largest bank in the country right here. So as you can see, or at least it was until recently, but during 2008, something like this would have took the entire market down with it. But what's going on is as things like this blow up, they're not just letting them fail. Like, if you hold over $250,000 in an account, that's on you. But in reality, what's going on is when this thing goes into receivership this weekend, as many people expect, and when the market closes, there's a good chance that all those people are going to be perfectly fine. They're not going to have to just take those losses. Like they have $130 billion worth of asset, or $100 billion worth of assets still. So they're not. It's just really weird. Like when we have major banks, like this was trading at $147 in February, that are just straight up failing right now. These aren't little banks. Like these are major banks that are just straight up failing, and the market doesn't care. As you can see, the market could care less. And you can go right here. You can look at it. Um, maybe when it goes into receivership this weekend, the market might react a little bit on the first, but the market doesn't care. As you can see, it's only First Republic down. If you go to the other ones, Zion's is actually up. Um, WAL, or not like WAL, Western Alliance, barely off. So the market is kind of assuming that a lot of this is contained. So if you go back to this report that I linked in a previous video on like commercial real estate, this is still the ticking time bomb that's out there. This is just out there. You're going to see a lot of businesses going out because they have to cover the cost on these things. You can see little businesses here and there if you're in your local area that are going out of business because they're having to raise rents so high that they're just closing. We just had you just kind of look around and see it, but this is that report that I linked before. I'll still link this again, but this is a very good read on what's actually kind of going on with these banks. And this was written up by JP Morgan. It shows all the different areas, and then down here it shows which banks are exposed to what. Um, so if we find, I think First Republic is in here somewhere, but it shows what they're trying to sell right now to raise money that they can't sell it to raise money. That's their problem. That's why they're losing so much money right now. And they're talking about takeovers. But I'll definitely link this again in the thing. So what am I doing with the portfolio? Like what's going on with the dividend portfolio? Obviously, it's still a passive portfolio, as you can see. I've been putting money into the money market fund, as you can see. 75, 50, a little bit of money here and there. It is currently at 4.78%. And then also I've been adding money into AFB. So I did do one minor change, and I posted this on Twitter. As you can see for AFB, I shifted this up to 25% of the portfolio, and then I shifted this right here down to 5%. So if we go to my rules, so anything above 5% is going to show in green now. So what does that mean? Am I going to sell BS? No, I'm not going to sell it. So what I'll do is I'll just increase my AFB position, and then BST will fall down by itself as I increase that position. And then also I have dividends that are paying out tonight on SPHD. But the portfolio is pretty balanced where I want it to be. So this needs to go up to 25. So I added 100 here, or I bought 10 shares just today. And as you can see, the ultimate goal is right here. These are the percent breakdowns. So 45, 25, 10, 10, 5, 2. And that's kind of the ultimate goal for the monthly right there as it lines up. So this is the dividend right now, goal, the number of shares. So this also breaks down my goal and how many shares I currently have. And as you can see, 228 versus 807. So definitely have a ways to go, but I'm getting there. So you just gotta have a plan. I would recommend if you ever do want to come up with a goal, just come up with something like this, so that you know where to put money when you have money. Um, and then also there was I want to post this too. This is a dollar cost averaging, the big thing that's on Dividend Twitter, dividend investing videos versus contributing in as a lump sum. And this shows you if you just save up a large amount of money and then invest it, it has a better outperformance than if you just dollar cost average whenever something's down like 1%, for example. So this is kind of the Warren Buffett way of doing it, but you can kind of, I'll post this link too if you want to kind of read over and just kind of see this little animated graph that I found. But as it currently stands, so I guess let's do some predictions on what I think might happen. Um, it depends on consumer spending. I think consumer spending is going to be just fine. It's not going to be strong, crazy strong kind of stuff, but I think you're going to continue to kind of see. I think the Fed is going to raise rates on at the beginning of May, and then they'll probably say pause. If Powell comes out and says the word pause, the market's going to rally in May. It's just going to happen. There's going to be a celebratory rally, but then there's all those lag effects. So you still have all that stuff, all these commercial loans in the background that are just rolling over at higher rates. Um, just any kind of loans that are out there that are just rolling over at higher rates. Like the corporate debt is rolling over at higher rates. Um, the biggest threat, I guess, if you want to say, is going to be the debt default. I think that's going to be more of a June story. But the thing that's going to cause one bank after another to fail, it's going to be the commercial side. Um, I'm not sure if FRC is in here right now. It should be. I thought it was. But like you can kind of get the general idea. Just the banks like SBNI, Y was on this list, UBS was on this list. There's going to be some problems. The longer that these rates stay high, the longer that I think pretty much anything above this line is in trouble. That's a lot of banks. SBNI, NY already taken out. FRC probably getting taken out this weekend. But I think this kind of stuff, because what happens is when they need to raise money, they can't. The real estate, the things that they hold just aren't worth enough when they try to sell it to raise money. And that's what they tried to do yesterday, and they tried to sell it. Nobody wants to buy it. They tried to sell their assets, and nobody wants to buy it. So I think we're going to kind of run into problems. The longer that rates are this high, is the longer you're just going to see banks in that list that I just showed you just going to be kind of just in a really bad spot. Um, Hopefully the Fed realizes this and they lower rates because this is also another chart that I wanted to show you. Um, is this it? No. There's another chart that I had that I believe I have somewhere around here. Might have saved it on my phone, but basically it's just that rate cuts are still priced in. Um, so these rate cuts are still priced in, and the Fed hasn't even talked about doing rate cuts. In fact, they're going to raise at the beginning of May, but the market is pricing in rate cuts. This whole rally right here. That's what all this is about. Earnings came in good, and rates might be coming down. That's what this rally is about. So we got to kind of see what's going to go on there. But I think the commercial real estate side is still a time bomb. I wouldn't touch banks at all. I wouldn't go near them at all because this is what you get. So that's where we're at right now. We got to kind of watch it. Definitely depends on the consumer. Definitely depends on the on how long the Fed keeps rates this high, and it could be bad. So we gotta have to keep watching it. And then I'll make my next video on the 15th. So Hope y'all have a nice day. Thank y'all for watching.